Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro, technicals, and a touch of crystal ball gazing. Today is Monday, March 31st, 2025. Today's episode begins with our headline, Lynn Alden's March 2025 newsletter review. If you're watching this video, you're probably familiar with her work. If you're not, close this video and listen to her instead. She's become sort of a juggernaut in the financial world for some really good calls that she's made, rivaling views of major banks. She's interviewed on tons of different shows. Anyway, she has a newsletter, and it's worth signing up for it, and it's worth reading. I think you can find it on her website. This is her website right here, lynnalden.com, March 2025 newsletter. In a nutshell, the newsletter basically says don't get too excited about AI in general and expect the unexpected. So let's go through the main points of the newsletter, which I put here as the 4 main points that I got out of it. Number 1, there's Elon Musk now for over a decade or more has been saying self-driving cars are 2 years away, and he keeps pushing it off another 2 years, another 2 years, another 2 years. And it basically has to do with the fact that portable AI, this is our second point, that portable AI can't handle the real world yet because chips are nowhere near efficient enough. You'd need way too much power right now. A whole data center, you can't put an entire data center worth of power into a car. Now, will that somehow get to cloud computing? And you have to worry about, well, what if it disconnects and you're about to get into an accident, that kind of a thing, obviously. And then on top of that, even the best systems can't actually compete with the human brain yet. And that the human brain is actually still magnitudes above that level when it comes to dealing with the real world. She notes that the human brain only uses 20 watts of power, and to replicate the brain in computers right now, you have to use many thousands, if not millions of dollars of power to come close to that amount of processing power that the human brain has running on only 20 watts. She brings up a chart from Ray Kurzweil's book. I don't think this chart is updated, but this is the chart that she's referencing from a Ray Kurzweil book. I believe that this was published in 2005, 2006. It says 2006. So some of these data points I think were speculative, and my understanding is that we're on the lower part of this band. But the fascinating thing about this band here, first of all, this is an exponential chart. So a straight line up would be exponential growth. And this is a curved line up. This is like double exponential. I'm sure someone that knows math better than me, there's got to be a word for that, right? Double exponential. Point is, on this side, calculations per second per $1,000 on the left-hand side, and then you have years starting in 1900 going all the way up through 2025. And yeah, so I believe these last 3 dots are actually lower on the band. But the main point here is that we're many magnitudes still away from having a human brain be operable on $1,000. And that's per second. Ray Kurzweil's latest book was actually just released in 2024. The singularity is nearer when we merge with AI. That's the one Lynn Alden says has been updated and has at the bottom of the band. I scanned through the book. I can't find the chart myself. But anyway, moving on. Number 3, AI disruption will affect white-collar jobs faster than physical labor or humanoid robotics. It's kind of funny because there's been so much hype about, a third of American men drive trucks and all of their labor is going to be gone because of AI. And we keep believing that that's 2 years away, and we may be much longer away from that than we currently have been thinking. And You know, it's funny enough, while people have been assuming that it's been blue collar jobs like manufacturing, driving trucks, making stuff with your hands, we were thinking that it would start replacing people in all of these scenarios, and it will little by little, but it's actually more than anything, and it already is affecting white collar jobs. I no longer have to hire somebody to do my taxes when I have ChatGPT to talk with, you know, for such a lower cost, for nothing really. Just as a small example, complex tasks that use a lot of thinking, you know, they can be done by the computer easier than manual tasks. So it's very funny, and I love read the article to get all the points. But anyway, I found that to be fascinating. And then number 4, she says that energy systems and blue-collared jobs will likely remain stable, benefiting energy producers, infrastructure providers, and industrial firms. And so that's her stance on investment opportunities that come out of this idea. Her stance for a long time now has been, why are people bearish on energy? We need energy. We need lots of energy, especially for the AI. If we want more AI to do more stuff, it requires a heck of a lot of energy. And that humans have been very good at making it more efficient, but not so much that, you know, you should be bearish on the entire energy industry. You know, one of her main points that she's made many times in the past as well is that we don't typically get rid of old sources of energy. We kind of just add new ones to it. We're still burning coal, by the way, to make energy, if you didn't know that, which I've noted on this show actually a long time ago was actually a very obvious opportunity with coal producing companies for a little while. I'm going to add to this conversation regarding her newsletter that I believe education will be massively disrupted. I mean, the amount that I personally am able to learn from home for free using AI to help me understand things I don't understand that I'm reading in books or that I'm finding online, or someone says something and I don't really get it. And it's just, I mean, the biggest disruption that I see coming is education, actually, in the very near term, personally. I think that the cost of an extremely good education will go to zero very, very soon. But, you know, that's just me and my crystal ball. Moving on to the community topics, Tuesday and Wednesday, it's possible I won't do a show. I'm going to be on the road. I'm not sure if I can do it or not. I will try to at least write a post in the community post section, the community section of YouTube. So make sure you subscribe if you want to keep up with my posts. Also, later this week, coming up, tomorrow we have job openings. Can be a huge report if this ends up showing weakness. That could really make things fall apart really fast. This is one of these reports that can send things really flying. And then Wednesday you have ADP employment, which acts as a pretty good precursor to what may happen on Friday when we have the unemployment employment report, which is, in my opinion, the most important report of every month, and it comes out this Friday. After all, again, you can't have a recession or a depression if everyone has all the work they want. So unemployment is very key for understanding where we are. Still no major changes in the daily reminders. Watch Macro Update 21125 to hear me explain them. And watch Portfolio Update 21125 to hear me explain my crystal ball ratings and my portfolio, minus this stock that I got. I'm still short gold, by the way. If Gareth is short at this level, I'm short. He's still short here, so I'll sit on it. It's like such a tiny position. If I lost the whole thing, it's like, it's nothing. But I told you I'd keep it updated, so that's the update. Charts, SPX, the S&P 500. If you watch CNBC or television, they might say, oh, the stock market went up. Well, yeah, it did, kinda. It opened quite a bit lower. We dipped down to this previous trend line that's acted as pretty good support. I wouldn't be surprised if we have to fight here for a little while before we can break through it. But as far as the chart pattern goes, this does not look bullish to me at all, not yet. Add to this the most updated information for junk bond credit spreads, high yield corporate credit spreads actually widening. This adds to bearishness. Again, if the S&P 500 is falling off a cliff and credit spreads are not doing anything, well, that's the bond market saying, come on, Mr. Market, have a little bit of patience. But the bond market is not saying that. The bond market is still spreading at actually a very rapid pace very recently. Again, these are not like just more rapid than before, let's say. No, I take that back. That's a good amount. From 3% to 3.5%, that's 0.5% in only a few days. So if that continues, that adds weight on Mr. Market to be like, yeah, no, we are in a little bit of trouble here. The VIX alarm bell is ringing. We are still, although we opened higher on the VIX, the fear index, the prices options contracts, we closed above 20, and as expected, the VIX future term structure is totally inverted right now, so the alarm bell is ringing. The market's on fire. On fire apparently, so much so that TLT, my favorite place to be, continued up a whole another percent. This was a bit out of left field for me. I thought for sure, if I was a day trader, I definitely actually would have shorted TLT there with this head and shoulders pattern here. I mean, it's perfect. It's classic. We broke through it, we tested it, and then you go down, right? Well, no. We went above it. I mean, granted, this line still can act as an intact. We can still get below it, but, traders aren't going to be eager at this point to be shorting TLT. So maybe we won't get to this gap fill area. At least doesn't look like it wants to go there anymore right now. Another way to see where yields are going, this is TLT upside down, the 10-year Treasury note yield. Granted, it's only 10 years instead of the 24-year duration that TLT has. But anyway, other chartists are talking about this head and shoulders, looking like it is going to indeed play out. The target on this in the near term would be 3.43% on the 10-year Treasury note yield, although we have not cracked the neckline yet. Oil popped up way above the $70 level. I'm understanding professional chartists are going short now. Oil had a bit of a pop today, somewhat because of political events with what Trump is saying about oil and Russia, and the price of oil went up, at least for the day. My understanding is expectations are still that oil will be dropping here, but I don't know. A chart that really caught my eye today was SMH, the semiconductor index. It appears that we are at the neckline. This orange line here, let me get rid of this blue line. All right, this orange line here represents the neckline of this head and shoulders top, and we poked our head below it today. This is interesting. If this pattern plays out, the target price is around $123 on SMH, which is a humongous drop. That's an over a 50% drop from this range we've been in. And there's an adage on Wall Street that says where the semis go, the rest of the market goes. This can act as a leading indicator, and right now it's looking hecka bearish, let's say. I wanted to also bring up the 10-year break-even inflation rate. This is the best market as far as what the market believes the inflation will be in the United States over the next 10 years. And again, we're currently at 2.38. And as I said in my daily reminders, we've been in this range for a long time now, between a peak of 3 in April 2022 and a low of 2% in September of 2024. And right now we're sort of hovering in the middle. If tariffs and all of this was like, yes, inflation is really actually coming, we would likely see that reflected here. We're not seeing that. This market is saying we're not worried about inflation right now. And this is the US bond market. This is like big money, big market. I wanted to bring up Treasury yield curves today only because, as I've been saying for a while, we're pretty much stuck at 0 between the 10-year and 3-month. And after, again, historic inversion, and then coming out of the inversion and now just sitting at 0, deciding, is the Fed strangling the economy still, or is it not? We're unsure. That's the game that this market's playing. Another traditional metric that people have used for a long time is the 10-year minus 2-year, because it helps look a little further out. What is the pricing of the 2-year Treasury versus further out on the 10-year Treasury? And when you have this going up and up and up, that is a signal, typically after an inversion, that we are still headed into a major slowdown or recession usually. If you, for example, scroll out here, when this goes up, recession, and then during good times it goes down, okay? And then it goes up, recession. It goes good times, it goes down. Up, recession, every time, right? So I more recently came across the idea that you can look below 0 to see what direction it's going at. And I'm just going to say that the 10-year minus 2-year Treasury has been in an uptrend since March of 2023. So that is 2 years ago. We have seen higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. I doubt we're going back into strangling mode at this juncture. But what do I know? I'm just a guy with a crystal ball, and that's all for me and my crystal ball today. Hope you enjoyed. Thank you for watching, and see you next time. Also, I bought a little more MSOS today, MSOS. I think that market is past or at its max fear, and that's why I'm maintaining 2% position still. Robschild.